Right, we're back after a little break. Hey, Robert.
Hey, Yaron, it was nice to see you last week.
Yes, it was nice to be in California, mostly. And so today we're going to continue our discussions. We've been discussing crypto over the last few sessions. We've also published a number of Substacks on the issue, and indeed, the riff we talk about today, there'll be a Substack entry coming out soon that elaborates on this. So we thought today we talk about a different dimension. Last time we talked about governance, using crypto as a form of enhancing governance or changing governance, really, a changed governance set. Today we want to talk about crypto as in terms of transactions. It's its ability to transact. There's been a lot of talk, particularly with Bitcoin, about using Bitcoins to buy Teslas or to buy other kind of products. There's been a lot of talk about Bitcoin one day replacing the dollar and being used as currency and so on. But there have been other coins that have been attempted to buy, maybe on a narrower spectrum of kind of products, to use for the purchases of goods. There's certain transactional cost benefits supposedly for doing so. But there's one fundamental problem right now with using crypto for transactions, and that's volatility. So maybe talk a little bit about what makes it difficult to actually transact in crypto.
Well, I think if we're not going to solve the problem of using crypto to transact, then we need to rename it. You know, it's not a currency.
Yeah.
You're not going to use it in your daily life. So when you look at Bitcoin, just as an example, and you think about buying a Tesla with Bitcoin, the problem is that the relevant metric, which is the dollar amount, varies so much over relatively short periods of time. So if you were going to buy a Tesla in June and you were planning on, spending $75,000, over the course of the month, it might have cost you 3 Bitcoins on average. But at the beginning of the month, it cost you 2 Bitcoins. But at the end of the month, it cost you 4 Bitcoins. So, your price is wildly different depending on when you actually hit the buy button on the Tesla website. And that's just not how people are interested in transacting. People don't typically want to combine gambling with their daily purchases. And so while a little bit of price variability seems to be okay, we see people buy things, using, that are denominated in a foreign currency when they don't know what the exact exchange rate is going to be, but they have confidence, and it's justified confidence, that it'll be within a certain band. They know roughly how much they're paying on a dollar basis. So we need to solve that. And it doesn't really make sense to think about crypto as being the foundation for a whole new financial ecosystem if we don't solve that problem. And the way that it's been solved so far is to create stablecoins. And stablecoins are a cryptocurrency that, instead of fluctuating with supply and demand in the open market, is pegged to a particular dollar value. Now, it could be pegged to any sort of value, but dollars is what people care about. So it's pegged to a dollar value. It's almost always $1, which very much follows what people are used to in money market funds, where the unit of the money markets fund is a single dollar. And if you are earning interest, you end up with more units all worth $1, as opposed to a bank account or a Bitcoin, which, a bank account will go up with interest and Bitcoin will go up and down with market prices.
So, the crypto markets realize this. There's a lot of attempts to innovate around this idea of creating stable coins to create some kind of link that stabilizes the value of coins around $1. And they've been really 2 main attempts to do this, kind of the dollar-backed stable coins and the algorithmic stable coins. So let's start with the dollar-backed stable coins. Tether is a good example of this, but there are others, and they've been in the news because while they have not gone bust, there were worries about them. So let's walk through maybe how a tether or a dollar-backed stablecoin works, and then we'll look at kind of the risks inherent in it, or the business model that it requires.
Well, these dollar-backed stablecoins are basically electronifying the money market sector, because you take in money. So you would send Tether dollars, and then they would issue Tether, and they would take the dollars and they put them into some sort of account, a very, ideally a very safe dollar-denominated account where you might be earning, these days 2% interest on the account. But it's in something that is not volatile, so that you are confident that if you want your money back, you want to swap those tethers for dollars again, you can get back the exact number of dollars. And it's fairly easy these days for Tether to do that, because if they're putting the money into securities that earn 2%, maybe 2.5%, because treasuries are now earning, the short-term treasuries are earning 33%, then they can easily convert tethers to dollars and dollars to tethers.
And that's because the T-bill market is so deep, there's so much liquidity, it's easy to go in there and buy and sell without moving prices. So you're pretty confident in your ability to convert every coin into a dollar.
That's right. The entire universe of tethers, if they all need to be converted into treasury bills today, it would account for about 10% of daily volume. So if it was all today, they might push prices a little bit, but we're talking about that same little bit like foreign currency exchange, where it's really not what people are concerned about. People are concerned that they won't get a dollar back. They only get 95 cents back, or 90 cents back, or 80 cents back. And so that's a really good model for keeping the price of the tether stable. Now, it wasn't a very good model a year ago when interest rates were zero, because you put the money in the account and there's no interest income. So there's nothing to pay Tether for providing the service. There's nothing to cover the costs of managing Tether. So it's something that only works when interest rates are positive. And it's a difficult business model, because if you are capturing that spread, the difference between what the securities pay and the fact you're not paying interest on the tether, and that spread is tiny, then you're not making any money. And if that spread is large, then competition is going to flood it. And so dollar-backed stablecoins are going to get increasingly popular. You're going to see more and more versions, and what they'll start doing is paying interest. And so instead of just holding Tether and getting the benefits of having a stablecoin, you would hold Tether plus and get the benefits of a stablecoin plus 1% interest a year. So your tethers would grow slightly. Every tether would turn into 1.01 tether each year. And that would be more attractive, and people would move to Tether Plus, and then Tether would have to say, okay, we'll give you 2%. And this is exactly how financial institutions work. They compete, which keeps the spreads at a manageable level from the perspective of a customer. So when interest rates get high, your bank account starts paying more interest.
And it, it kind of stabilizes the profit margin through competition. It reduces and stabilizes the profit margin the Tether itself has. So, but there is a temptation here. We see it in banks. Particularly banks are regulated, so there's a limit to how much of this they can do, although you can create the kind of incentives where they cheat. But so what happens over time if I, as Tether, if I want to increase my profits a little bit, if I want to juice it up a little bit, where can that lead?
Well, then you start reaching for yield. So if you have to pay 1 or 2% to your Tether customers, then earning 2 to 3% is a lot less attractive. So you start to think, well, how can I earn 3 to 4%? And if you look out in the market, you can earn 3 to 4% without taking a lot more risk. Now, you're not in treasuries anymore. You're in commercial paper. You're not just in Apple commercial paper. You're stretching a little bit, but it's low risk. Unfortunately, this cycle never ends. And as you take a little bit more risk, that's both credit risk and liquidity risk, then a shock to the system can cause things to blow up. And we saw that with Lehman Brothers. Charles Schwab had these sort of cash-like accounts for their customers, and they had invested a lot in Lehman commercial paper. They went down like 36%, which was supposed to be impossible. And then they got sued and they had to pay out tens of millions of dollars. Like there's a lot of fragility that gets into these systems over time, particularly when things have been going smoothly. It's much, much worse in a case like Tether, where there's no transparency. So we don't know what Tether is holding. Tether has published some broad categories of what they're holding, but there's a big difference between Apple commercial paper and Chinese real estate developers commercial paper.
Yep.
If it's not super safe, if it's not super liquid, and if it's not denominated in dollars, then it's not particularly good for backing a stablecoin, but it can be very good for creating profit for the backer of the stablecoin.
In the short run, yeah.
Well, when times are good, and then when things blow up, it gets even worse, because if things start to blow up, then you're underwater. Nobody knows you're underwater, but you have to eventually get back above water. And so you just take more risk and hope for the best. And that's why these things almost inevitably break down without significant transparency and then significant competitive pressure based on that transparency to minimize risk.
So right now, Tether has promised to have the balance sheet audited, but it hasn't really happened. And that audit is supposed to provide transparency, and that doesn't exist. Where does you'd expect, therefore, competitors to rise to Tether that provide that kind of transparency? Are we seeing that at all?
We are. I think 5 years ago, and for someone who will give them what they want. And I don't know anything about Tether. I don't have any specific information. I just know what the incentives are, and I know that there have been times where Tether has taken big risks, and they've paid off because crypto was in a boom market. And so in a bear market, with zero interest rates, I would predict Tether is screwed. Now, we're not at zero interest rates anymore, so it may muddle through, but you're exactly right. It's not like these problems are like we've just uncovered them. The people who are sophisticated and interested in the potential risks are aware of this. We saw when Terra Luna blew up, Terra trade down to about 95 cents. That's not a very stable coin. And get, I think, $16 billion in redemptions, which they covered and are trading back close to $1. So there certainly wasn't a situation where they had all their money, all the supposed dollar backings in Bitcoin that had gone down by 60 or 70%. But we just don't know, and not knowing is a problem. So the US dollar coin is slowly then catching up, and then at that point started rapidly catch up to Tether to threaten to become the leading dollar-backed stablecoin, because US dollar coin is promising to hold 100% short-term treasuries, which really is what, if you're a stablecoin holder, that's really what you want.
Yep. Yeah, which they can afford to do now with 2% interest rates. I'm not sure they could afford to do.
No way a year ago that it could have worked. Now, sometimes if we had the same problem with money market funds, and sometimes a bigger institution will choose to run it at a loss. Because when interest rates are zero, you can't run your money market fund, charge fees without having a negative interest rate, which nobody's going to accept. So a lot of these funds went down to 0.01%. And the Fidelity or Schwab or whoever was sponsoring the fund would just eat the costs because it was a part of doing business for the customers.
So that's one side of the spectrum, which is the safer side. Still some uncertainty there and some potentially bad incentives without transparency. What's the other extreme? The other extreme is this algorithmic stablecoin. So maybe walk us through how the algorithmic work. I guess the prime example of this was the Terra Luna pair that was around until a few months ago, and then now it's gone.
Yeah, Terra Luna was a really interesting idea. It was a very innovative approach to creating a stablecoin. It was doomed to fail. It was designed to be extremely fragile. and basically to only work as prices were going up. But that doesn't, I mean, in Ingenuism, we're all about trying things. And
Yep.
even though you might be sure that it's going to blow up, maybe you can figure out a way as you go to have it not blow up, and you'll never be able to do that if you don't start it. But I certainly am not surprised that the Terra Luna pair broke down. But what the design is to create a stable coin, Terra, that would be anchored at $1, but be anchored via the second cryptocurrency, Luna. And Luna was a market-based currency, so it could trade up or down. And as long as the price of Luna was going up, as long as there was growing demand for Luna as the back-end coin, it was actually pretty easy to keep Terra stable at $1 because you committed to issuing enough Luna to exchange Terra for $1 worth of Luna. So if Luna's at $100, you only have to give 0.01 Luna in exchange for a Terra for them to get $1 worth of Luna, which they could actually sell because Luna is a market coin. And if Luna is going up, there are fewer and fewer Luna being committed to cover the existing Terra. And the reverse is true if Luna is going down. If Luna goes from 100 to 50, now it's 0.02. And you have twice as many of the Luna committed to covering the Terra. Absolutely not a problem going from $50 to $100, but if it starts to steadily go down to 40 to 30 to 20, and there's an increasing number of Luna that are necessary to commit to cover all of the Terra, then it starts to break down. So there's supply and demand for both Terra and for Luna. And as long as demand is strong, it's easy to keep the price pegged at $1. As demand for both of them starts to fall, then you get into a death spiral where there's more and more Luna being created to cover the Terra, which drives the Luna price down, which makes people less interested in holding Luna, which makes them worried about holding Terra, which it just falls apart.
And that's what happened whenever it was. It was earlier this year. That's actually what happened in reality, where Luna basically went down to zero. Both went down basically to zero.
And in theory, if you ignore zero being a weird number, in theory, you can always cover the existing Terra with your Luna because you can issue an unbounded a number of Luna. So you could issue 100 trillion Luna to cover. But when you get down close to zero, then it actually all breaks down because it doesn't matter how many you issue of Luna. If people have given up on it and set a price of zero, then you still have zero.
Yeah, so I think that any currency where people have given up on using it, basically don't want to use it anymore, is worth zero, is worth nothing. If for whatever reason, 100, 200 years ago, people had decided, no, gold is actually worthless, we don't want to trade, then gold becomes worthless.
If we discovered that gold was like lead and it slowly poisoned you, it would have been a total reversal of people's attitude towards gold and then the value of gold.
So we've got these two models. I mean, the algorithm is clearly inherently unstable. It cannot survive, particularly not a downward spiral. Again, we saw that. Have we seen any other algorithmic stable coins, or is this it? And if they survive this current big decline in crypto?
So there haven't been any big projects. With crypto, you can start out very small, and many small projects just wither on the vine, and that's great because this is the trial and error that you learn. But what was unique about Terra Luna is that it grew to be tens of billions of dollars worth of crypto, and it was literally out of nothing. Bitcoin was also literally out of nothing, but it took a long time for adoption to happen. And a lot of the adoption is speculation. It's not adoption as a use case, whereas Terra was going to be an alternative stable coin and potentially replace, and was actually on a trajectory to replace the other stable coins that were dollar-based because it had a much better business model in the absence of the death spiral.
So what is it that attracted people, you think, to the Terra Luna model, given that given this death spiral theoretically is likely to happen in a down market.
I would say it's inevitable, although,
Yep.
I'm not saying it wouldn't have been impossible to figure out a way to navigate that. You would need a lot of runway to figure out a very forgiving market. I think new things, especially innovative things, are inherently exciting. People want to get involved. I'm not sure that anyone would have used Terra as opposed to Tether as a stable coin, given that it's not the sexy, can go up a lot. It's set at $1. It's supposed to stay $1. It won't go down, but it also won't go up.
Yep.
And so you've got this trading between Terra and Luna, but all the juice, all the excitement is in Luna.
Right.
So I'm not surprised that Luna went up a lot, because any cryptocurrency, that goes up a lot, whether it's Dogecoin, it can be anything. And some of them were started as a joke. This was a serious innovation. Yep. So I can understand that. On the Terra side, I think it would have been a much harder sell. It would have been a lot less interesting, except for the fact that it came up with a second innovation, which was essentially interest.
Yep.
It created what they call the anchor protocol, because you're anchoring Tether, but the anchor protocol, where if you locked your coins inside the protocol, basically like you're putting them into the bank, then you would receive 18% interest. So you would accrue more coins for just having them sit there. And this is in a world where interest rates are zero. So 18% interest is amazing. But of course, that kind of rate should always trigger alarm bells. It's not going to end well. Yep. You need to have extraordinary value being created underneath. And we've just never seen, not even in Silicon Valley, we take venture capital as a whole, or early stage startup angel invest. We've never seen anything that can reliably produce 18% through good and bad times. Mm-hmm. You're either, well, that's a whole nother riff.
Yeah.
But it made Terra look very attractive from a crypto perspective, because most cryptocurrency, you're speculating on the price will go up. Here, you just lock it up and price automatically goes up. Now, it won't go up double, triple, quintuple, whatever you're hoping for in Bitcoin, but it'll go up reliably and steadily over time, and 18% compounds really nicely. So most of the Terra ended up being locked up instead of being used as a stable coin for people to get in and out of more volatile cryptos like Tether and USDC are being used. It was used to immediately lock into the anchor protocol, which in the short term made it really easy to keep the anchor, because there are very few Terra trading. So if the price deviates, if it goes down to 99 cents, you don't have to do a lot of shifting from Luna to Terra to support the price back to $1. It's not a very thick market. But eventually there are going to be a lot of Terra that are unlocked out of the protocol, because whatever's in Anchor is growing at 18% a year, and the 18% compound means the number of Terra is growing very rapidly. So it was something that made it much more interesting to hold Terra. Luna was the exciting, had all of the upside of this new innovative platform for cryptocurrency. And so I'm not surprised there was early demand. And the people who bought Luna early, well, they made a lot of money as long as they sold, as it went up. And people who bought Terra early, again, as long as they cashed out, they made their 18% in the Anchor protocol. It's one of those things where if you're in early, you do well, and later, well, that's not so good.
Yep. And there was in the Terra Luna kind of universe, there was attempts to create some functionality to actually use these coins for something, to create business models around them that never really matured. And it seems like maybe that was an effort to create, I think, what you view as maybe the next innovation, which is kind of a blended stablecoin. So it seems like they were trying to get there, but they put the cart before the horse. And maybe you need to create the use first and then create the stablecoin, not the other way around. But it's unclear.
Certainly the evidence from Terra Luna suggests that, because you would have needed a long runway to build an ecosystem where there was a lot of value being created. So people would look at Luna and say, yeah, I want to hold that, and then look at Terra and say, oh yeah, I can use that because it's tied to Luna, and Luna is really valuable. Because
Yep.
if you think about it, the dollar backed coins, they're tied to the dollar, and the dollar's not, it has its own risk. We think about a dollar because dollar's a dollar, because it
Yep.
is. But if you look at historically, currencies have been debased, governments have failed, countries have been conquered. Like there is a lot of safety in dollars, but there is no certainty in this world, including the dollar. And so making Luna something that looked more like a dollar, where everybody's using it and everybody accepts that it's valuable, and that would have been very interesting. But that's, if you look at how long it took Bitcoin to have a reliable value and not to teeter at the edge of going back to zero. It was years before people heard about it, started using it, and started to agree that it was worth something.
Mhm.
So I think it would have a much better chance of success if you did get the horse in front of the cart. And we've talked about this idea of using crypto as the basis for organizing and then funding and building innovative new ideas. And the example I like to use is a crypto version of Airbnb, which we call the Stay Network, where you just organize the entire effort around a cryptocurrency, which we call a stay coin, that is used to rent houses, rooms, experiences, whatever is happening on the Stay Network. So people want to use it because it's valuable to be able to either as a host to be able to find guests that'll pay you, or a guest to be able to find unique properties that you can rent out. Like, we all know why Airbnb is valuable. And so if you do that, that creates demand for the stay coins and potentially permanent value, even though they're a currency that was created out of nothing, because really every currency is created, every fiat currency is created out of nothing. And so we look at that example and you say, well, wait a minute, Stakecoin is going to be like Bitcoin, which is good because people agree it has value, but the value is going to be volatile. Just like Airbnb stock is volatile, how much value there is in that network of hosts finding guests. Well, in March of 2020, it looked like it might all go to hell because no one was going to travel again. And they certainly wouldn't want to stay in other people's homes. But then it turned out what they really didn't want to do was stay in hotels, and the demand for Airbnb skyrocketed. And if the Stay network had existed, it suddenly would have been thriving. But it would have been a wild ride. And it was for Airbnb stock. I mean, Airbnb was on a trajectory to go public. The pandemic started, and they raised emergency cash that was at a valuation that was lower than their valuation a few years ago, and turned out to be about a quarter of their valuation of when they went public at the end of 2020. So this kind of wild ride, Bitcoin-like price fluctuations is not great if you're talking about booking your vacation home. If you're going to spend $2,500 and you actually don't know if it's going to be $1,800 or $3,200 until you press the button, that most people are not up for that kind of uncertainty.
So it's an interesting. So it's both has the characteristic. It's both used as a currency to buy stuff, to buy a vacation, and as equity, and has the volatility of equity.
Yeah, because the only value comes from demand for the coin to use on the platform. And if the platform is thriving, it goes way up just like the stock would. And if the platform is struggling, it's going to go down just like the stock would.
So while it's completely acceptable as equity to be volatile, we expect that from equity. And you mentioned that Airbnb is like that. The equity is. We need something stable in terms of to use for purchasing, and this is where we can create a stable coin to facilitate transactions. And so how do we do that?
Well, I think it's absolutely necessary. I mean, in theory, Apple could give you an iPhone for a share of Apple stock.
Yeah.
But Apple doesn't do that because that's not what their customers want. The customers who are buying the stock want one thing, the customers buying the iPhones want something different. So on the Stay Network, I think we would have to create something that would reflect what an equity-like investor would want, which is the exposure to the upside and the downside of the Stay Network's future success. And that would be the Stay coin, but it would need a stable coin Now that stablecoin could be the dollar, it could be a tether, but what would be most interesting is if it were actually created in conjunction with the state coin, not necessarily at the same moment, but where they're tied together. And this is the Terra Luna model, where you create something, a second currency, I'll call it a stay buck, because it's going to be linked to the state coins, but it's going to be anchored at $1. And so if you are renting a home and it is $400 a night, really it's 400 stay bucks a night, you're going to pay with stay bucks, but the value of those stay bucks isn't going to vary in the same way that the state coins would, that the equity-like security would.
So and then you can convert the stay bucks into state coins so that you can benefit from what if you believe there's upside in the state coin in the network itself.
And you have to have that link, because something has to anchor it at $1. You can't just say, okay, stay bucks are worth $1 unless you're willing to back that up. Now you could back it up with $1, like a dollar-backed stable coin, and keep the dollars, but then you're keeping a bunch of dollars. Like, that's not very interesting. It's not innovative. It's just a drag on the business model. But if it's backed by the state coins in the Terra Luna model, then you get all of the innovation of an algorithmic stablecoin, but without the same level of fragility, because it still depends on there being demand for state coins, but that's not just coming out of the ether. That's because you have this network that's thriving. You have demand for state coins because you're getting more and more houses listed, more and more guests coming, renting houses. You've got this virtuous cycle that's building the network out. It's basically becoming Airbnb. There's a lot of demand for the network, and that's all going to show up in the price of the stake coins. It can't show up in the price of the stay bucks. The stay bucks are $1. So all the excitement about the network, all of the actual demand from using the network is going to flow through to the stake coins. So now we have Terra Luna, except instead of Luna going up just based on sentiment, stake coins are going up based on sentiment and based on the actual utility of the stake coins as part of this stay network. And so as there's more demand for the stay bucks, and that's driving the price up, because that's what you actually use to transact, you're getting rid of stay bucks because they're the expensive thing. So you want to sell those, and you're buying stay coins. So you drive the price of stay coins up instead of letting the price of stay bucks go up.
So what happens if demand for stake coins, because demand for renting houses, whether because of competition or whether because of an economic event like COVID, the demand dries up and the price collapses. How do we keep the state buck at $1?
Well, initially it works because you have the prices of state coins going down. You've got demand for state bucks going down, and you are now taking out the lower price stay bucks and shifting that lack of demand into state coins. So as long as the state coins are still worth something, which means you believe in the network as a whole, then you don't get down to zero. The problem with Terra Luna is that Luna can literally go to zero. Now, if Luna goes to $1, that's not a problem. You can still cover all the existing Terra. Luna goes to 50 cents. You could still cover. It's only when you start to think this is not worth anything and it goes to zero, that the numbers don't work anymore. You can't issue an infinite number of Luna to offset the zero price, but you can issue a very large number of Luna to offset a very low price. So the problem is at zero. And as long as people have belief, I won't say confidence, because at this point the confidence has been shaken. It's a pandemic or something like 9/11 has happened. Nobody's going to be traveling. As long as though there's some potential for the network to survive and upside, then you'll end up with low prices, but not price of zero. And that'll keep it from breaking down. So all of the volatility goes through to the stake coin. And if at some point people look at the network and say, this is just not going to work, like nobody wants to do this anymore. Or maybe at the beginning, we all thought it would work, but it turns out nobody wants. Airbnb is a total flop. then you would end up with it crashing. You'd go into a death spiral. The whole thing would fail. And that's what happens when you create something that it turns out nobody wants to use.
Called bankruptcy. Yeah.
Yeah.
I mean, in the regular world, it's called bankruptcy. So the difference here between this and Terra Luna is the fact that the state coin is usable. There's something that we can use it. And if we can project that I'll be able to use it in the future, then it might not have a high value because demand has gone down, but it has some value, and that keeps it from zero. And it only achieves zero when just it's clear that this is not working and it has no future use.
Yeah, at some point, even if there's a few houses and a few guests, it doesn't cover the cost of the networks, and the whole thing gets shut down. It breaks down. And bankruptcy is an important part of the economic system. Like, you don't want a crypto ecosystem where nothing can ever fail. You want things to fail when they're no longer relevant. And that's what I think an algorithmic stablecoin that is tied to an actual use would end up providing you is that sort of trigger to say, okay, well, we've reached the threshold where this should all be shut down. Now, this picture, the economics are solid, right? The incentives are good. If you think of the incentives for the hosts, they're good. They're good for the guests. They're good for speculators. You don't have this zero bound problem. I think this would work, but the proof is in the pudding. What would be really exciting is to start seeing these sort of value creating efforts. So you get things getting organized that have a clear value. You get the horse out in front, and then having the crypto evolve into something that provided what everyone needed for that use. And then as you get more and more of these, you could easily have dozens of pairs like StableCoins and StableBucks that are all interlinked in the sense that they can be converted from one to another. So your host, right now, the way we've painted it is you'd be getting StableBucks and you'd be selling them. You'd be selling them to people who wanted to rent homes next month. And so you get your dollars, because eventually you want dollars. But for crypto to really be interesting and impactful, you don't want to have to go to the dollars. So you want another option, which would be like ride coins and ride bucks, where instead of cashing out in dollars, you could use these StableBucks that you're getting to pay for rides in the the Uber equivalent in Crypto Valley. And then you could use it for grocery delivery, and you could use it for and as it expands, it becomes more like what people imagine crypto could be, which is we use it in our everyday life and we never have to touch the dollar. As long as we're part of this ecosystem, we're getting crypto and we're using it. This I think it'd be very exciting to watch evolve in the real world as opposed to just in my head.
Yes, it'd be interesting. I mean, I think people are working on these kind of things. I think Terra Luna was the first kind of not very good attempt to do something like this. And you've got to believe that there's still a lot of money flowing into the crypto world. People are trying to figure exactly these kind of things out. So I think we're in for an exciting future.
Definitely. I hope Terra Luna didn't completely poison the well for algorithmic stablecoins. Maybe the
crazy ones,
the no anchor to reality ones, or the ones that pay super high interest.
Super high interest general principle should always trigger people to that's true in every financial transaction. If it's too good to be true, it's too good to be true.
Yep. But I don't think crypto is, but we'll
see. We'll see. All right, great. So we will be publishing in the Substack an article that lays this out in greater detail. So look forward to that. You'll have both the video and the article up as you listen to this. So thanks you, Robert. We'll see you again next week.
Thanks, Yaron.
Bye.